Can you imagine a property value skyrocketing by 600% or even 700%? That's exactly what's happening in Sarasota, Florida, where two properties have recently been sold for redevelopment at astounding price increases. Welcome to the Commercial Real Estate Insights Podcast. I'm your host, Steve Hamoen. Let's get right to it. In Sarasota, two properties have seen dramatic increases in their selling prices, marking significant developments in the local real estate landscape. The first property, a 2,467 square foot medical office building located across from the Marie Selby Botanical Gardens, sold for $3.6 million. This represents a 634% increase from the $490,400 paid by the previous owner back in 2006. This building, constructed in 1997, is part of a planned 66-unit mixed-use condominium development. The second property, located at 786 South Orange Avenue, was sold to the same buyer in May for $3.5 million. This sale reflects a 753% increase from the $410,000 the previous owner paid for it in 2005. Both properties are listed as part of the same development project, which aims to include a 66-unit building with nearly 18,000 square feet of commercial space and a 5-story parking podium. The buyer, an LLC named Unilog Orlando 1031, is planning a significant redevelopment of these sites. According to the Sarasota Observer, the project will feature 7 stories and blend residential and commercial spaces, contributing to Sarasota's evolving urban landscape. These price surges in Sarasota are indicative of a broader trend in the commercial real estate market, where strategic redevelopment is leading to substantial increases in property values. This is not just a Florida phenomenon. Similar trends can be observed in various regions across North America. For instance, in Kitchener-Waterloo, Ontario, we're seeing comparable developments where property values are being driven by innovative redevelopment projects. The value of a Manhattan office building at 1140 6th Avenue has plummeted dramatically, with its valuation dropping by 90% from $180 million in 2016 to $17.8 million today. The building's value per square foot now stands at $70, which is less than the previous asking rents. The owner, American Strategic Investment Company, is grappling with financial challenges, including a significant decline in occupancy rates, from 91% in 2016 to 69% in 2021, as well as a reduction in net operating income, falling from $9.5 million in 2016 to $1.6 million in 2023. The loan backing the building entered special servicing in April, and foreclosure proceedings commenced in June due to the owner's inability to cover the ground lease. A judge appointed a receiver in July. In a separate development, a federal court judge has confirmed a reorganization plan affecting developer Yitzchak Tesler. This plan will result in Tesler handing over the last 10 unsold residential units and 2 commercial units at 172 Madison Avenue to distressed debt investor ARX PE. Tesler had previously agreed to a reorganization plan that allowed him to retain the penthouse units and secure $35 million in exit financing, but he was unable to secure the necessary funding. ARX PE subsequently rejected Tesler's final attempt to retain the penthouses with a new co-developer. Following Labor Day, a team from Serhant will begin marketing and selling the remaining units. Meanwhile, an investor has purchased the 6-story retail section of 229 West 43rd Street for $28 million. This space was previously home to attractions such as Gulliver's Gate and National Geographic before the pandemic. The buyer, a Delaware company, acquired the property from the lender. The property was initially owned by the Kushner family, who had spent $295 million to acquire the Times Square asset a decade ago, but they lost the property to foreclosure last year. In Brooklyn, Avery Investments has purchased a development site in Crown Heights, previously owned by Yoel Goldman, for $10.1 million. Goldman had entered the site, located at 1550 Bedford Avenue, into bankruptcy earlier this year and had valued it at $14 million. Avery Hall principal Brian Ezra stated that the firm is considering multiple uses for the property. This acquisition marks another setback for Goldman's once expansive Brooklyn empire, which had grown to $1 billion before collapsing under significant debt, liens, and lawsuits. As we explore the evolving landscape of retail spaces, it's interesting to observe how Regency Centers is reshaping the future of open-air shopping in North Carolina. The emphasis on grocery-anchored shopping centers is becoming a key trend. In recent years, there's been a renewed appreciation for brick-and-mortar retail, driven by suburbanization and hybrid work models. These shopping centers serve as community hubs, drawing consistent foot traffic with necessity-based retailers and service providers, including top-tier grocers. This approach has proven resilient over time. Regency Centers' strategy involves transforming underutilized or aging properties into vibrant, modern spaces. This transformation is guided by a meticulous analysis of market trends and economic indicators to identify high-potential investment areas. Their focus on sustainability and energy-efficient properties aligns with current investor and tenant priorities, ensuring these spaces are not only profitable, but also environmentally responsible. One of the standout projects in Regency's portfolio is the Village District near downtown Raleigh. This 599,428 square foot open-air retail plaza is one of the highest performing properties in the Carolinas, attracting over 5.2 million visitors annually. Recent lease transactions have brought in notable retailers such as Sephora, Shake Shack, and Barnes & Noble. The opening of Maeve's first ever standalone store at this location further underscores the center's appeal. The Village District exemplifies a multi-use, multimodal destination, integrating retail with residential and transit options to encourage continuous activity. Currently under construction is the Hilton-branded Oberlin Hotel, which will feature 7 stories and 153 guest rooms, adding to the district's appeal. This site continues to attract a waiting list of retailers and restaurants eager to establish a presence. Another example of Regency's innovative approach is Blakeney Town Center in Charlotte. Acquired in 2021, the center is designed as an experiential community gathering place that blends retail with entertainment and walkability. This strategy of creating a sense of place involves connecting with and adapting to the community, thus driving increased foot traffic and attracting a diverse range of visitors. Regency Centers' efforts in North Carolina illustrate how staying ahead of trends, embracing innovation, and fostering community engagement are pivotal in shaping the future of retail real estate. Their approach not only enhances the shopping experience, but also strengthens community ties, creating opportunities for memorable moments and valuable connections between retailers and customers. Let's shift our focus to Rancho Cordova, California, where popular grocery chain Trader Joe's is making waves in the industrial real estate sector. Less than a year after acquiring a substantial 441,000 square foot industrial building in the Rancho Cordova Logistics Center, Trader Joe's has announced plans to expand this facility. This development signals a significant investment from the grocery chain, further cementing its presence in the region. The expansion is part of Trader Joe's broader strategy to enhance its logistics capabilities, ensuring efficient distribution and supply chain management. The original acquisition, which took place in late 2024, marked a strategic move for Trader Joe's, as they continue to bolster their infrastructure to support growing consumer demand. The decision to expand the facility underscores the importance of industrial spaces in facilitating the operations of major retail players. According to the Sacramento Business Journal, this expansion is expected to enhance Trader Joe's logistical operations, allowing for greater inventory management and streamlined distribution processes. As we see a growing trend of retail giants investing in industrial real estate, it's clear that having robust logistical frameworks is crucial for maintaining competitive advantage in today's market. The Rancho Cordova Logistics Center, where the building is located, is strategically positioned to serve as a key hub for Trader Joe's West Coast distribution. With the planned expansion, Trader Joe's aims to optimize its supply chain, ensuring timely and efficient delivery of products to its stores across the region. This move not only strengthens Trader Joe's operational capabilities, but also contributes to the overall economic development of Rancho Cordova. The expansion of this industrial facility is a testament to the growing importance of logistics and distribution centers in the retail sector. As consumer expectations continue to evolve, companies like Trader Joe's are investing in infrastructure that supports their ability to meet these demands efficiently. The strategic expansion in Rancho Cordova is a clear example of how industrial real estate is playing a pivotal role in the retail landscape. Thank you for listening to the Commercial Real Estate Insights podcast. I'm your host, Steve Hamoen. See you on the next one.